In modern consumer economies, financial leakage rarely comes from dramatic mistakes. It comes from routine. A5. Dollar coffee purchased during a rushed morning commute. A15. Dollar lunch justified as convenience. A few dollars spent on transportation that feels unavoidable. A small indulgence in the afternoon. And a growing list of digital subscriptions, many of which are barely used or entirely forgotten. Individually, each transaction appears insignificant, harmless, even, but markets and money do not operate on perception. They operate on accumulation. When these micro-expenses are aggregated across weeks, months, and years, they begin to resemble something far more consequential, a persistent capital outflow. Financial analysts frequently emphasize that the real threat to long-term wealth is not volatility, it is leakage. A consistent, unmanaged outflow of capital that prevents surplus from ever forming. And without surplus, there is no investment. Without investment, there is no compounding. And without compounding, there is no wealth. This pattern is not limited to any specific income group. Whether individuals earn modest salaries or six-figure incomes, the behavioral pattern remains strikingly consistent. Income arrives, and almost immediately it disperses. Not through deliberate allocation, but through habit. Through frictionless spending systems designed to make consumption effortless. Through psychological triggers rooted in reward, stress, and social comparison. Behavioral economists have long studied this phenomenon. The conclusion is clear. Most individuals do not lose control of their finances through large decisions. They lose control through small, repeated ones. This is why the concept of a paycheck routine has become increasingly important in modern financial planning. Because without structure, money does not stay. It flows. At the core of any effective financial system lies a simple but powerful principle. Separation. Specifically, the separation between what is necessary and what is optional, between survival and lifestyle, between needs and wants. On paper, this distinction appears obvious. In reality, it is anything but. Modern consumer environments are engineered to blur this line. Streaming platforms feel essential because they are used daily. Sharing services feel necessary because they save time. Dining out feels justified because it replaces effort. Over time, convenience becomes identity, and identity becomes spending. This is where financial clarity begins to break down. Because when everything feels necessary, nothing can be reduced. And when nothing can be reduced, nothing can be saved. This is why financial professionals consistently recommend a data-driven approach. Not assumptions, not estimates, but actual transaction, level analysis. The process is straightforward, but revealing A6. Month review of bank statements is typically sufficient to expose patterns. Not the occasional large purchase, but the recurring ones, the automatic charges, the weekly habits, the unnoticed renewals. These are the true drivers of financial drift. Once identified, each expense must be categorized with precision. The first category is non-negotiable. Essentials, housing costs, utilities, insurance, basic food requirements, transportation necessary for income generation. These form what financial strategists refer to as the baseline, the cost of staying operational. Everything else falls into the second category: discretionary spending, entertainment, dining, convenience services, lifestyle upgrades, impulse purchases. This category is not inherently negative, but it is flexible. And flexibility is where optimization happens. Once categorized, the next step is measurement. What does it actually cost to exist? Month to month. This number is more important than most people realize, because it defines the threshold between stability and vulnerability. Traditional budgeting frameworks often suggest that essential expenses should remain below 50% of net income. This is considered sustainable, but not optimal. More aggressive wealth building models, often used by high net worth individuals and institutional thinkers, target a much lower ratio, closer to 25%. At first glance, this may appear unrealistic, especially in high-cost urban environments where housing alone can consume a significant portion of income. But the principle behind it is not about immediate perfection. It is about long-term positioning. Because the lower the baseline, the greater the surplus. And surplus is the fuel of investment. From a macro perspective, this mirrors how corporations operate. Companies that maintain lower fixed costs have higher margins. Higher margins allow for reinvestment. Reinvestment drives growth. The same logic applies at the individual level. Lower personal overhead increases financial agility. It reduces dependency on income stability. It expands optionality. And most importantly, it accelerates capital formation. Achieving this level of efficiency requires trade-offs, sometimes uncomfortable ones, relocation to more affordable areas, shared living arrangements, downsizing lifestyle expectations, reevaluating transportation decisions. These are not merely cost-cutting measures. They are strategic reallocations, short-term sacrifices made in exchange for long-term leverage. However, cost reduction is only one side of the equation. The other is income expansion, and this is where many individuals underestimate their potential. Because while expenses have a natural floor, income has no theoretical ceiling. Labor market data consistently supports this. Individuals who invest in skill acquisition, negotiation, and alternative income streams often experience exponential income growth over time. Promotions, career pivots, freelance work, digital businesses, equity participation. These are not exceptions. They are increasingly common pathways. Financial independence is rarely achieved through saving alone. It is achieved through the combination of controlled spending and expanding income. This dual-engine model is what creates momentum. Once baseline expenses are defined and optimized, the system moves into its second phase, protection. Because before wealth can be built, it must be defended. The primary tool for this is liquidity, specifically a high-yield savings reserve. In traditional finance, this is categorized as a low-risk, low-return asset. But that classification misses its true purpose. Because this is not an investment, it is insurance. Markets are unpredictable. Economies cycle, jobs are lost, expenses emerge without warning, and when they do, liquidity determines outcome. Without it, individuals are forced into reactive decisions, high interest borrowing, asset liquidation at unfavorable prices, financial stress that compounds over time. With it, those same events become manageable, contained, temporary. Data from recent economic studies reveals a concerning reality. A significant percentage of individuals lack even a minimal emergency reserve. This creates systemic fragility, because without a buffer, even small disruptions can cascade into long-term financial damage. This is why financial planners consistently recommend building an emergency fund equivalent to 3 to 6 months of baseline expenses. Not total income, not lifestyle spending, but the true cost of survival. This distinction matters, because in a crisis, lifestyle contracts, but survival costs remain. Importantly, this reserve must remain liquid, accessible, unrestricted. Locking it into fixed, term instruments, illiquid assets, or volatile investments undermines its function. This is not capital meant to grow, it is capital meant to protect. Once this defensive layer is established, the system can begin transitioning into optimization and growth. But before that happens, one critical obstacle must be addressed. Debt, in its simplest form, is leverage. In controlled environments, leverage can amplify returns. It can accelerate growth, expand access, and enable opportunity. But in personal finance, especially at the consumer level, debt rarely functions as a strategic tool. It behaves as a drag, a persistent compounding force that works against capital formation. To understand why, it is necessary to reframe debt not as an obligation, but as a negative investment. Every dollar allocated toward high-interest debt is not simply a repayment. It is a guaranteed loss being neutralized. And in financial markets, certainty carries extraordinary value. Consider this from a portfolio perspective. Equity markets, over the long term, have historically returned approximately 8 to 10% annually. This is widely accepted as a benchmark for diversified index investing, however. This return is not guaranteed. It fluctuates with economic cycles, interest rates, geopolitical events, and investor sentiment. In contrast, high-interest consumer debt, such as credit card balances, often carries rates exceeding 20%. This is not variable, it is fixed, relentless. From a purely mathematical standpoint, paying off a liability with a 20% interest rate is equivalent to achieving a risk-free 20% return. There is no market instrument that offers comparable certainty at that level. This is why seasoned financial analysts often describe debt repayment as the highest yield investment available to most individuals. Yet, despite this clarity, many individuals delay addressing debt. Why? Because the problem is not mathematical. It is psychological. Behavioral finance provides insight into this disconnect. Humans are not wired to prioritize efficiency. They are wired to respond to progress. Visible progress, immediate feedback, Emotional reinforcement. This is where debt but in design. The first approach, often referred to as the avalanche method, is rooted in optimization. It prioritizes debts by interest rate, highest to lowest. The objective is clear: minimize total interest paid over time. The second approach, known as the snowball method, is rooted in behavioral momentum. It prioritizes debts by size, smallest to largest. The objective is different: create quick wins that reinforce commitment. From a purely analytical perspective, the avalanche method is superior. It reduces total cost. It shortens repayment timelines. It maximizes efficiency. However, real-world outcomes are not determined by spreadsheets. They are determined by consistency. Studies in behavioral economics suggest that individuals who experience early success, even if financially suboptimal, are more likely to remain committed to long-term plans. This is the core advantage of the snowball method. It builds momentum. So the question becomes, is it better to be optimal or consistent? The answer depends on the individual. Highly disciplined individuals, particularly those with strong numerical reasoning, tend to benefit from the avalanche method. They are able to delay gratification in exchange for long-term efficiency. Others may require reinforcement. For them, eliminating smaller debts quickly creates a sense of control. Progress becomes visible, motivation increases. In institutional finance, this distinction rarely exists. Algorithms optimize, systems execute, emotion is removed. But personal finance is not institutional. It is human. And human systems must account for human behavior. Regardless of method, the objective remains unchanged: eliminate high-interest debt as quickly as possible, because until that burden is removed, all other financial strategies operate at a disadvantage. Investing becomes less effective, saving becomes less impactful, and financial stress remains elevated. Once debt is eliminated, a critical shift occurs. Cash flow is liberated. The funds previously allocated toward interest payments become available for productive use. This is one of the most overlooked inflection points in personal finance, because it is not just about removing a liability, it is about unlocking capacity. At this stage, individuals transition from defense to offense, from preservation to growth. But before aggressive growth strategies are deployed, one more structural advantage must be secured: tax efficiency. Taxation is one of the most significant, yet least optimized, components of long-term investing. While market returns receive the most attention, after-tax returns ultimately determine real outcomes. In many cases, investors focus intensely on selecting assets, stocks, funds, sectors, while overlooking the structure through which those assets are held. This is a critical oversight, because identical investments can produce vastly different outcomes depending on their tax treatment. For example, capital gains taxes can significantly reduce net returns over time. Dividends may be taxed annually. Short-term trades may incur higher rates. However, certain financial structures are designed to mitigate or entirely eliminate these inefficiencies. In the United States, one of the most powerful tools available is the Roth IRA. This vehicle allows individuals to contribute post-tax income, invest it, and withdraw gains tax-free under qualifying conditions. From a compounding perspective, this is transformative because it removes friction. In finance, friction is the enemy of growth. Fees, taxes, transaction costs, all of these reduce the effectiveness of compounding. Eliminating or minimizing them accelerates wealth accumulation. Other jurisdictions offer similar instruments. While the names differ, the principle remains consistent. Create an environment where capital can grow without interference. Within these accounts, asset selection becomes the next focus. And here, simplicity often outperforms complexity. Low-cost index funds have become the cornerstone of modern portfolio theory for a reason. They provide broad market exposure. They minimize fees. They align with overall economic growth, rather than attempting to outperform the market, a task that even professional fund managers struggle to achieve consistently. Index investing accepts market returns. This approach is not based on pessimism. It is based on probability. Decades of data show that the majority of actively managed funds underperform their benchmarks over long time horizons. Fees, trading costs, and imperfect timing erode performance. Index funds eliminate many of these variables. They are passive, systematic, efficient. One of the most widely referenced benchmarks is the S&P 500. It represents a broad cross-section of the U.S. economy. Large cap companies, industry leaders, global revenue streams, Over extended periods, it has delivered average annual returns in the high single digits. Not spectacular in any given year, but powerful over decades. This is the essence of compounding, not speed, but persistence. A modest, consistent investment, deployed over a long time horizon, can produce outcomes that appear disproportionate to the initial input. Time transforms scale. If debt elimination represents the removal of resistance, then investing represents the introduction of force. And in finance, force is not defined by intensity. It is defined by consistency over time. Compounding is often described as the eighth wonder of the world, but that description, while popular, lacks precision. Because compounding is not magic. It is mathematics applied over time under conditions of discipline. At its core, compounding follows a simple principle. Returns generate returns. Growth builds upon growth, and time amplifies both. Yet, despite its simplicity, compounding remains deeply misunderstood, not because it is complex, but because it is slow. At first, in the early stages of investing, progress appears almost insignificant. Monthly contributions feel small, annual gains seem modest. There is little visible transformation. This is where most individuals disengage, because human psychology is not naturally aligned with delayed gratification. Behavioral studies consistently show that individuals overvalue immediate outcomes and undervalue long-term benefits. This is known as present bias, and in investing, it is one of the most expensive cognitive errors. Because compounding does not reward intensity, it rewards duration. The first 10 years of investing often produce limited visible results. The next 10 begin to show acceleration. But it is in the third and fourth decades where compounding becomes exponential. This delayed payoff structure creates a paradox. The most powerful phase of wealth accumulation occurs at the point where most people have already lost patience. This is why automation becomes critical. Automation removes decision-making from the equation. It eliminates hesitation. It bypasses emotion. Instead of relying on willpower to invest consistently, automated systems ensure that capital is deployed regardless of mood, market conditions, or external noise. This has two major advantages. First, it enforces discipline. Second, it neutralizes timing errors. Market timing, the attempt to predict short-term price movements, is one of the most common and costly mistakes among investors. Even professional fund managers struggle to execute it successfully. Retail investors, influenced by headlines, social media, and short-term volatility, are even more vulnerable. They buy during optimism. They sell during fear. Automation disrupts this cycle. By investing at regular intervals regardless of price, individuals naturally adopt a strategy known as dollar-cost averaging. This approach reduces the impact of volatility. It smooths entry points. It removes the pressure of perfect timing. Over long periods, this consistency often outperforms reactive strategies. But automation is not just a technical tool, it is a behavioral solution. Because the greatest obstacle in investing is rarely the market, it is the investor. Emotional decision-making, driven by fear, greed, and uncertainty, leads to suboptimal outcomes. Automation creates distance, and that distance creates clarity. Once an automated investment system is in place, the next lever for wealth acceleration becomes increasingly important: income expansion. While compounding operates over time, income determines scale. A higher income allows for larger contributions. Larger contributions accelerate compounding. This creates a feedback loop. Income fuels investment. Investment generates returns. Returns increase net worth. Net worth expands opportunity. This is how financial momentum builds. Yet many individuals remain overly focused on cost cutting. They optimize small expenses while ignoring large opportunities. Cutting a $5 daily expense saves approximately $1,800 per year, valuable but limited. Increasing income by $10,000 per year produces a far greater impact. And, unlike expenses, income is not capped by necessity. This is why high-level financial strategies prioritize income growth alongside cost control. There are multiple pathways to income expansion. Some are traditional: career advancement, skill specialization, industry transitions. Others are more modern: freelancing, digital products, content creation, e-commerce. And increasingly, hybrid models are emerging. Individuals combine stable employment with scalable side ventures. This diversification of income streams reduces risk. It also increases upside. From a financial systems perspective, income diversification mirrors portfolio diversification. Multiple sources reduce dependency on any single stream. This is particularly important in uncertain economic environments. Labor markets evolve, industries shift, technological disruption accelerates change. Relying on a single income source introduces concentration risk. Diversification mitigates that risk. But beyond risk management, there is another advantage. Optionality. Additional income streams create choices. Choices create leverage. Leverage in this context is not borrowed money. It is control over time, decisions, and direction. This is where financial independence begins to take shape, not as a fixed number, but as a reduction in constraints. At this stage, individuals are no longer operating purely within survival parameters. They are making strategic decisions. They can choose where to live, what to work on, how to allocate time. This transition, from reactive to proactive, is one of the most important shifts in personal finance. However, alongside structured investing and income expansion, there exists another category of financial activity, one that operates under different rules: high risk, high reward allocation. A certain point in the financial journey, a shift begins to emerge. The foundational layers are in place. Expenses are controlled. Liquidity is secured. Debt has been eliminated or reduced to manageable levels. Long-term investments are compounding in the background. At this stage, the system is stable, but stability, while necessary, is not the same as acceleration. This is where capital allocation begins to branch into a new category: asymmetric opportunities. In traditional finance, most investments are symmetrical. They carry proportional risk and return. A diversified index fund, for example, may deliver steady long-term growth, but it is unlikely to produce exponential outcomes in short timeframes. Asymmetric opportunities operate differently. They are defined by an imbalance between downside and upside, limited loss, potentially unlimited gain. This is the domain of entrepreneurship, early-stage ventures, speculative assets, emerging technologies. These opportunities are not designed for certainty. They are designed for possibility. From a portfolio construction standpoint, this category plays a very specific role. It is not the foundation. It is the amplifier. Because while the probability of success in any single high-risk investment may be low, the magnitude of success, if achieved, can be transformative. This is known as the power law distribution. A small number of outcomes generate a disproportionate share of total returns. This principle is widely observed in venture capital. Out of dozens of investments, only a few may succeed. But those few successes can return the entire fund, and more. The same logic can be applied at a smaller scale to individual investors. Allocating a controlled percentage of capital, typically 5 to 10%, into high-risk, high-upside opportunities introduces optionality. Optionality is a powerful concept. It represents the ability to benefit from uncertainty without being destroyed by it. In practical terms, this means risking a small portion of capital for the possibility of outsized returns, while ensuring that failure does not compromise overall financial stability. One of the most accessible forms of asymmetric opportunity is entrepreneurship. Unlike passive investing, entrepreneurship offers two distinct advantages. First, it provides direct control. Second, it generates income in addition to potential equity value. This dual return structure makes it unique. However, entrepreneurship is often misunderstood. It is not simply about launching a business. It is about solving problems in a way that creates value. Markets reward value creation, not effort, not intention. This is why many well-funded ventures fail. While resource-constrained startups succeed, constraints drive efficiency. Efficiency drives innovation. When capital is limited, decision-making improves. Resources are allocated with precision. Waste is minimized. This is one of the paradoxes of early-stage success. Less capital can lead to better outcomes. From a strategic perspective, allocating a portion of income toward building a side business can produce asymmetric returns over time. Even if most attempts fail, the experience gain compounds. Skills improve, market understanding deepens, execution becomes more effective. And occasionally, one idea works. When it does, the impact can far exceed the cumulative input. This is asymmetry in action. Alongside entrepreneurship, another category has emerged over the past decade. One that remains highly debated, often misunderstood, yet impossible to ignore: digital assets. Cryptocurrencies. Few financial innovations have generated as much polarization. Supporters argue that blockchain technology represents a fundamental shift in how value is stored and transferred. They point to decentralization, transparency, and global accessibility as transformative forces. Critics, on the other hand, highlight volatility, regulatory uncertainty, and speculative behavior. They question intrinsic value. They warn of bubbles. Both perspectives contain elements of truth. From an analytical standpoint, cryptocurrencies occupy a unique position. They are not traditional assets. They do not generate cash flow like equities. They are not backed by physical commodities like gold there. Value is derived from network effects, adoption, and belief. This makes them inherently volatile. Price movements can be extreme. Sentiment shifts rapidly. External factors, regulation, technological developments, macroeconomic trends can dramatically influence valuation. For this reason, prudent allocation is essential. Within a diversified portfolio, digital assets are typically treated as a high-risk satellite position. A small percentage, often around 5%. This ensures participation in potential upside while limiting exposure to downside risk. Risk management remains the central principle, because while the upside may be significant, the possibility of loss is real. In extreme scenarios, certain assets could decline to zero. This is not hypothetical, it has happened. Therefore, capital allocated to this category must be capital that one can afford to lose without impacting overall financial security. This is the defining rule of speculative investing. At this stage, the financial system is complete, income is structured, expenses are controlled, liquidity is secured, debt is minimized, investments are compounding, optionality is introduced. Each component serves a purpose. Each layer reinforces the others. This is what transforms financial management from a series of isolated decisions into an integrated system. And systems, unlike intentions, produce consistent outcomes. Over time, this system begins to exhibit a powerful characteristic: acceleration. In the early stages, progress is slow. Savings accumulate gradually, investments grow modestly. But as capital increases, the dynamics change. Returns begin to generate meaningful income. Income increases investment capacity. Investment capacity accelerates returns. This creates a compounding loop. At a certain threshold, often around the first 100,000 in net worth, this acceleration becomes noticeable, not because of a specific number, but because of scale. Capital begins to work harder than labor. At this point, the nature of wealth shifts. It is no longer solely dependent on time spent working. It becomes increasingly driven by capital efficiency. This is the transition from linear income to exponential growth, and it is the defining moment in the journey toward financial independence. But perhaps the most important element of this entire system is not strategy, not allocation, not even return. It is consistency. Because none of these principles produce results in isolation. They require repetition, execution over time, discipline through uncertainty. Markets will fluctuate, opportunities will evolve. But a well-structured financial system remains adaptable. It absorbs shocks, it captures growth, it compounds quietly in the background and over decades. It transforms ordinary income into extraordinary outcomes, not through luck, not through timing, but through design. Because in the end, wealth is not built by intensity. It is built by systems that endure.